Hi everyone, welcome back to my channel. Today we're going to be talking about government assistance. If you're watching this video in 2022 or 2023, there's probably a high chance of this being on your exam because the government have given out a lot of government assistance throughout the years because of the pandemic, and I think CPA would like a lot of their accountants to know how to account for them. If you like what you see, make sure to subscribe and hit the like button as videos come out weekly. Also, in the comments below, let me know what you thought about this video. In terms of the overview for today, we're going to go through some key terms that you need to know. Then we're going to go through a technical discussion where I'm going to show you a template that you can use to get C's on all of your exam. Make sure you pay attention to this part because it's going to be important. And then we're going to go through scenarios on what happened if your grant becomes repayable. And then I'll show you some additional key technical as well. The next section is going to be a case example of a forgivable loan for expenses. And then we're going to go through another example of a government grant where it's for capital expenditures. Now let's go into our first topic, defining what is a government assistance and a government grant. So now let's get some boring stuff out of the way. A government assistance is defined as an action by government designed to provide economic benefit specifically to an entity qualifying under certain criteria. So that means the government's going to give something, normally it's money of some sort, to companies who qualify for some requirements. And then now let's talk about a government grant. It's assistance by government in the form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to operating activities of the entity. So this could be government giving out, again, money for, let's say, the company having to meet specific targets or having to do specific activities while they're operating their business. So now let's talk about the technical discussion, which is a lot more interesting because you're going to learn how to get a C on this topic. This is going to be the most important slide of the entire video, so make sure you pay close attention. This is going to be your template on how you get a C on this topic. Number one, you need to ask if it's a government grant. So the case is going to talk about something and you need to basically state if it's a government grant or not and why. And then we're going to go into how to actually recognize it. And to be able to recognize something as a government grant, you have to meet all of the following criteria, which is number one, there needs to be reasonable assurance that the enterprise will comply with all of the conditions, which means the company is going to follow any requirement that is needed to get the money. And then number two, the funds will be received. Note here, it says will be. So that means you don't actually have to have the money in the bank before you start recording this government grant, as long as you believe you will be receiving this money. So then we talk about how is your money going to be used? Is it going to be for expenses or is it going to be for capital expenditures, which are normally your PP&E or your buildings? If it's going to be for expenses, you have to ask yourself, is it going to be for the current period or is it going to be for the future period? If it's in the current period, what you can choose from is the gross or net method, which is if you're using the gross method, you essentially recognize the gross amount as other income. If you're going to record it using the net method, you just net it off against an expense. I'll have examples of this later in the video to make sure everyone understands how this gross or net works. If the money is going to be used for expenses in a future period, what you're going to do first is defer it. So you're going to create a government grant liability, which is going to be used to offset any expenses later on. And again, we could use the gross method or net method as stated above, subsequent to recognizing a deferred government grant. If your money is going to be used for purchasing capital expenditures, you can either reduce the PP&E balance and amortize it like normal, or you can create another deferred government grant liability and then amortize it on the same basis as PP&E. Again, we're going to have an example that covers this, so don't worry if you're lost. The next step, you're going to recommend one of the approach. So don't just state all the approaches that you could have and say that, oh, it could be for expenses, it could be for PP&E. You actually have to tell the users, in their specific scenario, which one would you apply? Would you apply expenses or capital expenditures? Is it for a current period or is it for a future period? Lastly, you're going to conclude on the impact, which is normally talking about what the users care most about, whether it's net income, assets, or liabilities. Don't worry if you feel that this is kind of confusing because I'm going to go through examples using this template for both government grants on expenses and on capital expenditures. So now let's talk about what happens when you have to repay a government grant that was used for purchasing PP&E. Again, the reason why there's a repayment is because one of the conditions for the grant was probably not met. So what do? You first increase the carrying amount of the asset, or you reduce the deferred income balance by the amount that is repayable. And then the cumulative additional depreciation that would have been recognized in profit and loss to date in the absence of the grant shall be recognized immediately in the profit and loss. What that second bullet point means is that any depreciation that was negated by having the government grant should now be recorded in your profit or loss. So now let's talk about what happens when you have to repay a government grant that was used for purchasing PP&E. Again, the reason why there's a repayment is because one of the conditions for the grant was probably not met. So what do? You first increase the carrying amount of the asset, or you reduce the deferred income balance by the amount that is repayable. And then the cumulative additional depreciation that would have been recognized in profit and loss to date in the absence of the grant shall be recognized immediately in the profit and loss. What that second bullet point means is that any depreciation that was negated by having the government grant should now be recorded in your profit or loss. So now let's talk about some additional key technical. If the grant is received before any of your conditions are met, you're going to have a deferred grant liability. Essentially, you're going to have an unearned revenue. If the grant is not received but conditions are met, you're going to have a government grant receivable, which is an asset because you're expecting to get paid. If you have a favorable loan term, the benefit would be the amount received minus the present value of the loan. For those of you who want to know the difference between IFRS and ASPE when related to government grant, the key difference is that for non-monetary assets, in IFRS, they allowed you to record both the asset and the grant at either fair value or nominal value, whereas ASPE only allows you to record both the asset and the grant at fair value. So now let's look at our first case example. This one's going to be talking about forgivable loans for expenses. So in this case, it says that in 2021, the Canadian government provided businesses with a $60,000 loan with $20,000 forgivable if the business can repay $40,000 by December 31st, 2023. The funds can be used by the company for daily operations. ABC Inc. applied for the government assistance and obtained the full $60,000 loan in 2021. Initially, ABC Inc. was confident that they will be able to repay the $40,000. In 2022, $50,000 was used within the year to pay for rent. However, the company was unable to pay back any part of the loan until January 2024. The owner of ABC Inc. would like to know how they should have initially accounted for the loan, how the forgivable loan is applied to their rent expense, and how the repayment would be accounted for. ABC Inc. uses ASPE. So for anyone that wants to solve the problem on their own before they see the solution, feel free to pause the video. So now using the template, let's go through how we should initially recognize this transaction. First, we ask ourselves, was this a government grant? And the answer is yes. This is a government grant as it was funding provided by the Canadian government with the condition that if $40,000 can be repaid by December 31st, 2023, then $20,000 can be forgiven. So now let's see if we need to actually recognize this government grant. And we do that if all of the following are met. So the first criteria is that there's reasonable assurance that the enterprise will comply with all the conditions. And it said yes. In this case, the company was confident initially that they would be able to pay back the $40,000 and have the $20,000 forgiven. Number two, funds will be received. In this case, yes, the funds have been received as of 2021. The next question we ask is if the money was used for expenses or capital expenditure. In this case, it was for expenses. And then the follow-up question would be if it is for current expenses or future expenses. And as nothing was expensed in 2021, it wasn't for current expenses. This means it was for future expenses because it was used for rent in 2022. So we would first record a liability, then we can use the gross or net method subsequently. In the next section, you have to provide a recommendation. Make sure when you start your recommendation, you always say, I recommend. And make sure that the phrase that you start with is very firm and straight to the point. You don't want to be wishy-washy and be like, I recommend, perhaps, maybe, they could. Don't use any of those words, and you always want to be very strong in your recommendation. So you could say, I recommend that the initial $40,000 would be recorded as a regular notes payable with $20,000 recorded as a deferred government grant until it is used in 2022. And then we talk about the impact. As a result, the cash and deferred liability would increase. Even though the question didn't ask for journal entries, I wanted to show it just so that it's easier for everyone to follow. So in the initial recognition, you would debit your cash for $60,000, and then you would get the loan for $40,000, and you would credit a government grant for $20,000, which is essentially an unearned revenue. And then in the green, you could see that if we wanted to use the gross method, we would incur rent expense for $50,000, and then we would pay out that rent for $50,000. and then we would debit a government grant for $10,000 and then credit other income for $10,000. And effectively, the net rent amount that we paid would be $40,000. And then on the blue side, I tried to put the journal entry if we used the net method. You would essentially debit the rent expense for $40,000, and then you would debit the government grant for $10,000 and cash for $50,000. Again, the net rent expense is $40,000. In the red, you could see what happens in 2024 when the government grant needs to be repaid. You would first debit the government grant that you still have for $10,000, and then you would debit the loan for $40,000, and then I would skip a row and credit the cash for $60,000 because I know that's how much I need to pay out, and then I would have a plug for $10,000, which represents the loss, which essentially reverses the gain that you previously put in the income statement. Next, let's look at an example where the grant was used for capital expenditures. In this case, it says that the federal government has provided Anna with a one-time grant of $100,000. The grant is intended specifically for the purchase of tangible capital assets and must only be used for this purpose. Anna wants to know how to record the grant received subsequently to purchasing a building this year for $500,000. The building is amortized over 10 years. Now let's use our template to go through the analysis. The first question is, ask if it's a government grant. So in this case, yes. It is a government grant because Anna received $100,000 from the federal government for capital expenditures. Number 2, we need to see if we can recognize the government grant if all of the following are met. The first criteria is that it's reasonably assured that the enterprise will comply with the conditions. In this case, yes, Anna has purchased a building for $500,000, which is what the government grant can be used for. The second criteria is that funds will be received. Yes, in this case, the funds have already been received. The next question is, what is the money going to be used for? Is it going to be for expenses or capital expenditures? In this case, it's used for capital expenditures as the funds was used to purchase a plant, property, or equipment. So in this case, we have two options. We could either reduce the PPE balance and amortize it normally, or we could defer the government grant as a liability and then amortize it on the same basis as the PP&E. As a recommendation, in terms of the recommendation, I would put, I recommend that the government grant be netted against the PP&E for simplicity. In terms of the impact, as a result, PP&E, government grant, amortization expense, and net income will all decrease. Again, let's look at the journal entry to make this more easier to understand. So in purple, you can see the initial recognition, which is you debit cash for $100,000 and you credit the government grant for $100,000 for receiving the government grant. And then in green, you're going to see that we're going to amortize the government grant on the same basis as the PP&E. So when we purchase the building, we would debit our building for $500,000 and credit cash for $500,000. Then every year, as there's going to be building amortization, we would debit that by $50,000, and then we would credit building accumulated depreciation for $50,000. And then finally, we'll debit our government grant for $10,000 and other income for $10,000. In red, you could see what would happen if we netted the government grant against the PP&E when it was first purchased. You would first debit the building for $400,000, and then debit the government grant for $100,000, and then finally credit cash for $500,000. And then subsequently, when there's amortization, you would debit the building amortization by $40,000 and credit the building accumulated depreciation by $40,000. Effectively, under both methods, the building amortization would net to $40,000. Thanks again for watching my video, and hopefully you learned something about government grants. If you liked what you saw, please remember to subscribe and give this video a thumbs up. If you have any questions or comments, please let me know below.